Hello and welcome to the latest edition of the Halcyon Review. In this edition we'd like to talk to you about the different fixed interest investments that we use across our client portfolios. We often get questions from clients as to why we use different fixed interest investments and how they differ from one another. Therefore, we'd like to bring this video to you to provide some information that will help you understand the different investments that we use across your portfolio. In this review we will cover the following points: the role of fixed interest in a portfolio, what are the different types of fixed interest, and then provide a brief summary to close. The role of fixed interest in a portfolio. We want the fixed interest investments we recommend to achieve some or all of the following: a capital security and preservation, liquidity, consistent income, and low correlation to equity markets. The last point means that when equity markets fall, we do not want the value of the fixed interest portion of your portfolio to also fall. Instead, we want it to hold its value and act as a buffer to the value of the portfolio. What are the different types of fixed interest? Broadly speaking, you have three options to keep things defensive in your fixed interest portfolio. Cash is covered by the cash, term deposits and fixed rate investments, lend to high quality corporate borrowers, or lend to governments. The fixed interest portfolios we recommend to our clients typically include all three options. The more you move away from these three options, the more you introduce volatility and risk. When considering the options, it is important to keep in mind that any fixed interest investment is typically a loan from you to the borrower, made on the basis of receiving interest payments and repayment of your capital at a specified period in the future. Cash and term deposits. As the points on the screen show, this is the simplest form of investment, whether it be an at-call savings account or a term deposit, and also these investments are covered by the bank guarantee, subject to the dollar limits that apply per financial institution. Fixed rate investments. This is a common type of investment we utilise for our clients as a way of achieving a higher rate of return than cash or term deposits for what we think is a small effective increase in risk. The more regular payment of income compared to a term deposit is attractive from a cash flow perspective, especially for those clients in pension phase, whilst access to capital without interest penalty comes in handy should there be an immediate need for capital. The risk of this type of investment is the ability of the borrower to repay your capital. Again, the assessment we make on the borrower for this type of investment is that the risk is low and worth taking by our clients for the additional return. Corporate bonds. Typically, we access this type of investment via a fund manager and rely on the manager's lending processes and assessment of risk to only lend to high quality corporates. For example, the fund we typically use in this space had, as at 31 January 2018, 159 different loans to various corporates including Coles, Woolworths, Orica, Perth Airport and Telstra. Government bonds. We typically access this type of investment through a fund manager, though it is possible to access bonds issued by the Australian Government via the Australian Stock Exchange. Whilst the slide just notes bonds issued by the Australian Government, we can use fund managers that will access bonds issued by governments all around the world. One of the more technical aspects of investing in a government bond is that prior to maturity they can be sold for more or less than face value. In general, if interest rates increase, the price of the bond will fall. Conversely, if interest rates fall, the price of a bond is likely to increase. It is important to remember that the interest rate at issuance is fixed, and rather than the interest rate adjusting to moves in interest rates, it is the capital value that adjusts on a daily basis. Though it's important to keep in mind that if you hold your bond until maturity, you will receive back 100% of your capital, and any movements along the way are no longer relevant. Bonds, put simply, are just loans. It doesn't matter what type of fixed interest investment, they all involve lending your money to a borrower for the payment of interest and the return of capital. In our view, a well-constructed fixed income portfolio allows risks to be taken in other parts of a well-diversified portfolio with confidence. For example, exposure to Australian and/or international shares. I hope you found the information in this video useful. If you'd like any further information, please contact the office and speak to your advisor. Otherwise, we look forward to bringing you the next edition of the Halcyon Review shortly. Bye for now.